Hello and welcome to the Vivid Machines data room. For this video, we will walk through the 5-year forecast model, its structure, and underlying assumptions. So once you're in the data room here, navigate to the Financials tab on the left and download the Vivid Machines 5-year finance model. So let's jump in. So the Vivid Machines 5-year forecast model begins with a P&L structure with revenue, COGS, and operating expenses and it accommodates cash inflows and outflows outside of operating income here. These other inflows and outflows include non-dilutive grant funding inflows and outflows and capital expenditures as outflows. It should be noted as well that 2025 and 2026 can be viewed monthly, whereas 27 through 2029 are just presented annually. So the result is row 158, which provides the total cash requirement or the burn from running the business, excluding any additional sources of funding such as loans or equity financing. Key metrics are available to view, and a summary of cash sources is presented here at the bottom in row 181 and below, where we show $850,000 from existing cash reserves, $1 million planned to be coming from expected loans or advances against SR&ED and capital expenditures. And that leaves $3 million approximately as our desired equity financing round. We have forecasted in USD, but the majority of Vivid's operating costs are in Canadian dollars, so expenses are modeled in Canadian and then converted to USD. So that's the high level view of the model. Let's jump into the detail. Starting with revenue. In our business model, there are 3 components to revenue forecasting. There's farms, our customers, the acreage served on those farms, and then the number of cameras deployed. So starting with farms, we have the opening count of contracts from the prior year, and an assumption for churn, and an assumption for new logos. The churn assumption of 15% is applied in future periods. In the current period, this is an actual. With the farms, that count will lead us to calculating acreage. Again, starting with existing contracted acreage from last year, plus an assumption on expansion and an average acreage per new customer added, as well as the acreage lost by churn. So we have our existing acres, what we've expanded, what we've lost, and what we've added as new. The new just comes from the number of new logos times the average new contract size. You'll see here in row 23 a summary validation of the average acreage per farm. We start small and grow with a land and expand model over the years through 2029. These acreage numbers and farm sizes, as well as prices per acre you'll see later, do align with the bottoms-up model and value capture models, which are found in the go-to-market section of the data room. Bouncing back to the data room real quick, on the left, go to GTM, you'll see our bottoms-up market model and the value capture model. So finally, now that we have acreage calculated, the last piece is cameras. The total farm count and the acreage will drive the assumption on the number of cameras that are required based on an average number of acres serviced per camera. The number of acres a camera can serve grows over time as the system becomes increasingly smart and removes human elements such as calibration. The deployed line, either for the current model or the new model, XV3 is the current and XV4 will be future builds, as well as the new build requirement will drive other calculations in this model. So deployed is a revenue driver and new build requirement is a CapEx driver. This new build is in order to stock up on inventory to serve the year coming up. So at the end of 2026, we'll be stocking up to sell in 2027. Now that we have the three drivers mapped, we can move to the actual income statement and calculate some dollars. Revenue itself is calculated on a per acre basis and a per camera basis. Average revenue per acre grows from $60 to $350 in 2029 as we expand the number of use cases we can solve. Revenue per camera stays fairly flat in the model. Revenue is presented by camera in new and renewals, as well as by acreage in new acres, renewing acres, and expanded acres. That leads to row 57, which is total revenue for each year. In the operating expenses summary, the cost of goods sold includes personnel, which is our support staff or our on-the-ground field technicians, travel, which is mostly mileage of said technicians at $1,000 per customer per year on average, deployment costs, which is shipping and logistics at about $2,500 per new customer, data infrastructure hosting costs, which grows as a percentage of the acreage data revenue, and finally the cost of cameras. The cameras were financed and leased back and are leased back to us in 2025 and 26. So these costs are fixed. This is a more expensive than what we will do in the future, which is buying, capitalizing and owning the cameras and amortizing them over their useful life of likely 3 years, which shows here as amortized new build costs. Gross margins are presented in line 87 and show an improvement as time goes on. The reason for this is the same subset of customers grows in acreage and revenue per acre. Much of the cost of goods sold remain fixed and do not grow proportionally as acreage increases. For example, installation, personnel, and camera costs do not go up as more revenue is unlocked from expanding acreage and feature sets within a farm. The remaining operating expenses are broken into G&A, S&M, sales and marketing, and research and development. Operating expenses include consistent categories across each functional area, which are personnel, travel, and software. And then each functional area has its own. For example, G&A has office and general, insurance, and professional services. The travel assumptions and the software assumptions are driven by historical numbers. And the personnel details can be viewed in the headcount model supporting tab. As you can see, a list of names for existing staff, salaries, and then monthly breakout going out 5 years. And then below the line, we have all of our new hires and their hire dates for each department. The sales and marketing cost personnel includes sales reps and customer success reps. The sales and marketing also includes program spend for conferences and advertising, as well as distribution partners and commissions. Research and development costs include the development portion of AWS cloud hosting, as well as additional ML compute costs that we have forecasted. There's a significant investment in cloud compute for the machine learning to continue to be improved by further training models on new data that is collected, thereby increasing accuracy across all customers. So grants and government funding, which we do have confirmed sources of, have not yet been included in this operating income section. At this level of operating income, Vivid shows profitability in 2028. So the further cash inflows and outflows are presented here. and primarily come from our grant sources. In 2025, these grants have already been approved, and in 2026 and beyond, they are a combination of known grants and projections based on historical rates applied against larger staffing costs. Other cash inflows are the timing and collections versus the revenue recognized. So we back out revenue and add in collections, as most customers pay for a year in advance and often pay at the end of the year for a future period. And lastly, the outflows here relate to the cash required to build the cameras or some smaller other capital expenditures that the company needs, like buying computers for employees. So this leads us to row 158, which outlines the total cash requirements of the business. Vivid Machines expects to be in a cash flow positive position by 2027, with 4.6 million of burn leading up to that point. Key metrics are included as a summary below the cash requirements, and calculations are derived from the model itself, with the exception of CAC in 2025, which has been inputted with actual data in the CAC support tab found here, which is the trailing 9 months of expenditures on sales and marketing to acquire the customers in the January to June 2025 period. Future period CAC is derived from the model itself, and CAC does increase as the years go on because the annual contract value increases over time as we sign larger acreage contracts with larger customers. Lastly here, the cash requirement and the reason for this fundraise is to cover 2025 and 2026 cash burn of $3 million USD, which will be combined with the loans against Shred receivable of $1 million, as well as loans against potential camera building the cameras in the end of 2026 to support 2027, and the existing cash reserves of $850,000. For convenience, a summary of new hires are listed for the second half of 2025, as well as the 2026 new hires to help realize our growth plans. Thank you for watching this video, and I'll be happy to answer any further questions.